Hello everyone, I'm Miss A. Kavya, Assistant Professor, Department of BCom IT, PPG College of Arts and Science, Coimbatore. Today, in this video, we are going to see about the taxation of firms and AOP, definition of AOP and BOI. So, AOP is briefly called Association of Persons and BOI is briefly called Body of Individuals. So, AOP is a group of two or more persons which includes individuals, companies, firms, etc., who come together voluntarily for a common purpose under the Income Tax Act, which is differentiated by composition and purpose. This also includes individuals plus companies plus firms, and it is formed with a common objective like profit motive. It is a main objective, and the members actively participate in the activity. The clean example is that two individuals and a company join together to run a business. In this slide, we are going to see the clean difference between firm versus AOP. So now let us see about the firm. So first thing is it is taxed as distinct assessable unit, which is treated as a separate taxable entity under the Income Tax Act, and it is independent of its partners for taxation purpose, and the firm pays tax on its income, not the partners individually. So for example, a partnership firm earns profit and the tax is paid by the firm itself. Now let us see the second point about the firm. Specific deduction rules under section 40 subsection B. So in this, the Income Tax Act provides special rules for deductions which are related to partner salary, commission, interest on capital, and these are allowed only within prescribed limits under section 40 under subsection B. The last thing about the firm is members shares determinable. So in a firm, profit sharing ratio is clearly defined in the partnership deed, and each partner's share of profit or loss is known in advance. So now let us see about AOP or BOI. So the first thing is taxation is depends on whether member shares are determinable. If member shares are known, which is determinate, tax is applied accordingly. And if the shares are unknown, which is indeterminate, the tax is charged at maximum marginal rate. The second thing is default slab rates applicable. So this AOP or BOI are generally taxed using normal income tax slab rates like individuals. However, these are depends on conditions like types of income, share determination, etc. The last thing is optional section 115 BAC regime available. So in these AOP or BOI can choose the new tax regime under section 115 BAC and which offers lower tax rates but fewer deductions or exemptions. Let us see the fundamentals of assessment. The first thing is role of the assessing officer, and the second thing is documentation requirements, and the last thing is reporting obligations. So now let us see those assessment fundamentals in brief. So the assessing officer, who is shortly called as AO, is a tax authority responsible for examining and verifying the taxpayer's details. So it identifies whether the taxpayer is an individual, firm, AOP, BOI, company, etc. And it also checks whether the income declared is correctly using documents and records. And it also sends when the return is selected for scrutiny, which is detailed checking. And also issued when income is believed to have escaped assessment or reassessment case. Now let us see about the requirements, documentation requirements. So the taxpayers must maintain proper records and documents to support their incomes and claims. Agreements that shows profit sharing and terms among partners, and the member agreements which defines roles and income sharing among members. And the third thing is financial statements which includes profit and loss account and balance sheet. The last document required is Form 10B if applicable, where the audit report is required for certain entities like trust or audited cases. So now let us see about the income computation and deductions. Computing the net business profit. So this is the process of calculating the actual taxable profit of a business. So the first thing is start with gross receipts, which means total income earned from business activities. And next, deduct allowable business expenses under section 30 to 37. Um, Under this, expenses like rent, salaries, repairs, depreciation, etc. are reduced. And the last thing is apply entity specific adjustments, which is based on type of entity such as partner payments. So now we are going to add interest to partners or members, which are deductible under section 40 subsection B within prescribed limits. In this, interest paid on capital contributed by partners and members are shown, and it is allowed as a deduction under section 40 under subsection B, which I already mentioned, and it must be within prescribed limits, which is generally up to 12% per annum. Next thing is remuneration to partners, which includes salary, bonus, or commission paid to partners for their work. And it must be authorized in the partnership deed and it must be within limits specified under section 40, subsection B. And the last thing is carry forward losses. Business losses that cannot be fully adjusted in the current year can be forwarded to the next year. And it is allowed for firms and it is restricted for AOPs. Now let us see the impact of tax regimes. Now let us see the impact of tax reforms. So, which there is a great impact on old regime, new regime. No, under new regime, it comes under 115 BAC and it is strategic implications. So, under old regime, progressive slab rates with deductions under section 80C, 80D, and business expense allowances includes. Under new regime, lower slab rates, but most deductions were removed, and default regime from financial year 2023 to 2024 must opt out explicitly. And the last thing is strategic implications. Entities with high deductions may prefer the old regime. Annual comparison is essential for optimum tax flow. Now let us come to last slide, strategy conclusions, which moves for planning for success. So the first strategy conclusion is align structure with strategy. The structure of the business should match its goal and long-term plans. We should choose the right structure that helps in better tax planning, efficient profit distribution, and smooth operations and control. And a wrong structure may lead to higher taxes or legal complications. The second strategy is monitor regulatory changes. Businesses must stay updated with changes in tax laws and regulations. And the tax rules like sections, deductions, limits change frequently, and we have to track it always. So, this track helps in avoiding penalties and non compliance, and they can take advantage of new benefits and exemptions. And it also includes updates in Income Tax Act, GST rules, and government policies. The last strategy is engaging expert advisors. So the consult professionals like chartered accountants, tax consultants, and financial advisors are more preferable. And they help in accurate tax planning and filing, choosing the best business structure, and they help in handling complex regulations. So these consults may reduces risk of errors and legal issues. Thank you.